So I'm going to discuss the good aspects of high-frequency trading. So the title of the talk is High-Frequency Trading, What is it good for? Now this doesn't mean that high-frequency trading only does good. Okay? There are some arguments that it's doing bad in the markets. As Vladimir went through, there's these methods which seem nefarious, and which we know some high-frequency traders do. Now the question is, how large is that in the market? How important is that in high-frequency trading, and so on? I'm not necessarily going to get into that. I'm mainly just going to focus on an argument for the good in high-frequency trading. Okay? As long as you understand that that's what this talk is about, then hopefully you'll understand where I'm coming from and how I generated the slides in the way that I have. Okay, so I just want to give a very brief overview of the talk. I'd like to set the stage, give a summary of where we're going and what I'm going to discuss. So high-speed computerized trading, it's known as high-frequency trading, dominates modern financial markets. It's approximately 50% of all trading in modern financial markets. It's across the board. It's not only equities and futures, it's commodities, it's foreign exchange, it's emerging markets, and so on. Okay? Now, in some, there's been a lag in some of the other products. It kind of took hold in equities and futures, but now these other products are coming online. High-frequency traders are trading the other products, and we've seen the fraction of high-frequency trading in these products steadily increase. And it seems to be saturated at around 50% of all trades. And you can come up with an argument for why it should be 50% based on high-frequency traders being liquidity providers in the market, so they should be around half of the market. Evidence suggests that high-frequency trading increases market efficiency. So there's been many, many studies on high-frequency trading, academic studies. Almost invariably, they've all said that high-frequency trading increases market efficiency overall. Okay? However, there are serious concerns that high-frequency trading is unfair. Okay? Obviously, high-frequency traders are co-located at the exchange. This means they have some kind of an advantage. It's a speed advantage. There's concerns that it's destabilizing, and in fact, some of the research, some of the evidence that I'm going to show suggests why it is destabilizing. And then also that it siphons money from markets with no added social benefit. Okay? So those are the concerns. So the results. I'll use a special data set from NASDAQ. I show that high-frequency trading synchronizes security prices. So this is a special data set. It flags all activity by high-frequency traders on the NASDAQ exchange. Now, the NASDAQ exchange is the one who decided who was high-frequency trading and who wasn't. There's some caveats with the data, but for the most part, it's a very good snapshot of high-frequency trading on the NASDAQ exchange. With a simple model and drawing parallels with recent work in ecology, and I'll try and really strengthen that parallel between what's happening in markets and what happens in animal movements. I'll demonstrate how synchronization increases the accuracy of prices, lowers transaction costs, and also increases instability during times of market stress. Okay? So I'm going to give you evidence that high-frequency trading synchronizes things in markets. If you want to know the first order what high-frequency trading is, it's a synchronization process on the market. Okay? And then I'll give you a model that suggests how that should affect things in the market. So what is high-frequency trading? High-frequency trading, this is my definition, by the way, so this is one of the things, they have committees and so on who are trying to decide the correct definition of high-frequency trading. I like this because it's a little bit simple, and it doesn't get into the technicalities that much. But I consider it autonomous computerized trading that seeks quick profits using high-speed connections to financial exchanges. High-frequency trading is part of a larger trend towards automation in financial markets. So financial markets over the last 20 years have become much more automated. You should consider high-frequency trading as part of that automation process. It isn't the entirety of it, it's part of it. So in 1971, and this is the title graphic from his paper, in 1971 Fisher Black predicted that most activity on financial exchanges could and would be automated. So we have this nice, nasty looking machine here in the middle of a market that's connecting all of these different investors. And in fact, I argue that this is what high-frequency trading is today. And as you see, this was predicted all the way back in 1971. And sure enough, this is the New York Stock Exchange today. This is the server farm in New Jersey where most of the trades occur on the New York Stock Exchange. So I found this website. It's kind of an interesting website. It discusses trading pit history and trading pit nostalgia. So, and I'll read this off for those of you in the audience who may not be able to speak English. Across Europe, Asia, Australia, South America, and Canada, it's already ceased as a form of communication with the closure of all derivatives trading pits in those regions. Only 3 futures exchanges in the U.S. continue. Eventually, these last remaining pits will close and end the functional purpose of the hand gestures that hundreds of thousands used to transact and share information since the late 19th century. So this is a website dedicated to remembering the signals. So this was the language used in the pits. It's a dying language because trading pits, for the most part, no longer exist. They're no longer important. Everything has become electronic. So, as I mentioned, markets have become automated over the last 20 years. I like to separate this automation into 2 separate parts. The first is algorithmic trading, what I consider algorithmic trading. And I know some people consider algorithmic trading as all kinds of automated trading, but I consider it in a very specific sense to be the minimization of execution costs. So you take a very large order, and I've done some research with actually Fabrizio, who's going to give a presentation a little bit later, on understanding what happens in the market when you take a large order, and so that's what this represents over here. You have buys. These original orders are very large. Here's a buy order, here's a buy order from a different participant, here's a sell order. They're split up into individual sized pieces. Those pieces are then placed in the market in some kind of a sequence based on who's trading at what times, okay? And algorithmic trading is the automation of this process, and it's done to minimize execution costs. The other side of automation is high-frequency trading. This is short-term speculative trading. Okay, it's a completely different type of automation. And I should mention here on the floor. And again, this is automating things that have been done for 100 years in financial markets. On the floor, this was known as working in order, and basically they've just automated working in order. High-frequency trading is the other side of the coin. It's short-term speculative trading. On the floor, this was known as scalping or market making. Okay, high-frequency trading you should understand as the automation of that process. In some ways, high-frequency trading is actually quite small. Okay, it's implemented by small, obscure, proprietary firms. Here are some of the names of the major companies in the U.S. that do high-frequency trading. I imagine most of you haven't heard of these names, or if you had, it's because you've studied high-frequency trading. Otherwise, most people would never hear of these names. Most firms only have several $100 billion US in capital. Compare that to large hedge funds, which typically have $30 billion. Okay, so these are small players. Their total revenues are relatively small. They're approximately $5 billion per year, or according to another study, $3 billion per year. But on it's of order 1 to 10 billion. Compare that to total hedge fund revenue, which is approximately 100 times that. In other ways, high-frequency trading is very large. It's a very large part of the market. Approximately 50% of all equity orders and futures and now commodities, foreign exchange, and so on, those are slowly creeping up to around 50% of all transactions and all volume on markets is done through high-frequency trading. It's also very influential. It's changing the landscape of information technology. And Vladimir went through this a little bit, so I won't spend too much time, but these quicker data connections between Chicago, New York, and London and New York are all being driven by high-frequency trading. Okay, and it's it's all seeking faster and faster connections between the different exchanges. High-frequency trading worries regulators. So here's a quote from the chairman of the SEC, the main regulatory body for financial markets in the United States. And it states, a large portion of trading is unrelated to the fundamentals of the company that's being traded. It's got very little to do with whether you think IBM's got a great business plan, and a lot more to do with what's the minuscule aberrational price move that you can take advantage of because you've co-located your computer with the exchange and can jump on that in microseconds. And that worries me in some ways. Okay, so she's stating that high-frequency trading has little to do with fundamentals of the company. It seems to be entirely focused on these small aberrational price movements. How in the world can that really help? And here is the counterpart in the UK, Adair Turner. It is therefore not clear that high-frequency trading based on computer algorithms can possibly deliver significant positive social value. Price discovery at the nanosecond interval cannot possibly give a significant allocative efficiency benefit over price discovery on a second-by-second basis. So the argument here, you can kind of see it developing. It doesn't make sense. Why does it matter if markets operate on millisecond speeds rather than second speeds? Okay? Should that really ever matter in markets? I argue yes, and I'll show you why. Okay? And I think it's fundamentally important to understand why, because you have this argument which seems so compelling to begin with, that it shouldn't matter if you go from seconds to milliseconds. There's been numerous calls to study high-frequency trading. In the US, the SEC put out a concept release. In the UK, they have the Foresight Project, which recently just wrapped up, and they have a lot of interesting papers that were written based on the Foresight Project. In Europe, they put out calls for research as well. And as Vladimir went through, they've considered and are now implementing financial taxes. There's been countless newspaper articles. It seems like every day there's a new article on high-frequency trading in the press, at least in the US and the UK and Europe. There's even been a novel on high-frequency trading, and I'll quote it down here. At the nexus of high finance and sophisticated computer programming, a terrifying future may be unfolding even now. And it's pretty bleak in the book what happens. So what do we know about high-frequency trading? That kind of gives you the introduction. It's meant to supplement what Vladimir already mentioned. What do we know? Okay, what does the evidence suggest? Well, first of all, the evidence suggests that high-frequency trading increases market efficiency. The evidence suggests that it lowers transaction costs and increases the accuracy of prices. There's been numerous studies that have stated that. So here I do a plot. This isn't meant to necessarily connect high-frequency trading with lower transaction costs and better efficiency in prices. This is just meant to show that there has been the trend. In the same sense that there's been a trend in an increase in high-frequency trading in the markets, we have seen these benefits in markets as well. Okay? This doesn't do the strong connection between the two. That was done in these papers that looked at specific high-frequency trading. This is just to give you an overall picture. Sure enough, markets have become more efficient over the last 10 years. So here I'm using data for 35 large cap stocks. This overlaps the 35 stocks that I'm going to use later on in the high-frequency trading data. And I went back, used a different data set, the 2000, 2005, 2010, and I calculated the average cost and average pricing error for those securities, averaged over all of them, and sure enough, you see that the cost and error have come down. If you're interested in how I did that calculation, this is the original midpoint price in the market. P is the transaction price. So that difference between the transaction price and the original midpoint price I consider to be the cost. And then the error is the difference between the price 1 minute later minus the transaction price. Okay? And then the absolute value of that. That's how I'm calculating cost and error. So what else do we know? High-frequency trading potentially increases the instability of the market and creates spurious relationships in markets. Okay? So, as Vladimir mentioned, the flash crash in here, why don't you go ahead and, hold on 1 second actually, before you start the movie. So the flash crash Vladimir mentioned already, this was a very precipitous decline in the US markets. It happened over the matter of a few minutes, and then you saw a rapid increase come back again, okay? And this is really what woke the regulators up in the United States. And it shows you, if you put machines in charge of the markets, sometimes really bad things can occur, okay? Things that no human can understand. And so here, I'll show you a movie. Why don't you go ahead and play it? This is the trading pits. Someone is watching, observing the trading pits in Chicago as the flash crash is occurring, and you'll see the human response to what goes on. So go ahead.
Paper activity has been on the south side here, guys. Go out to the Mount One. 88 hours of trading, 87 even start trading, 86 even start trading, 85 even start trading, here now guys, all the way down, 84 even start trading, here now guys, 82 even start trading, paper comes in a big seller, 81 even start trading, here now guys, 79 start trading. 81 even bid, 84 even bid, 85 even bid, 87 even bid, no offers in the pit here, 91 even bid, no offers in the pit, 92 even, they just traded the figure. Once again,
so you could see the human response to what was going on. It was a little bit insane and didn't make that much sense. You had this huge drop. And in fact, if you listen to the whole commentary, the problem was the futures were in the pit were still trading at reasonable numbers. But they knew the figures that were coming out from New York. They knew the figures that were coming out on the electronic side. And there was this, oh, there's a huge, what's going on exactly? And so the pit then followed what was happening electronically, okay? And then there's this huge, anyway, it's a very interesting audio, and if you're interested, you should definitely go and listen to all of it. So another problem is correlations between equities and commodities have steadily increased as high-frequency trading has increased, and this was a study put out in 2012. So there's a possibility that it's creating spurious relationships in markets as well. Okay? Now, I should mention, so the Vladimir brought up the quote stuffing and some of these other things. There hasn't been a real, there hasn't been a smoking gun study on those kind of activities that shows that it's prevalent among high-frequency traders, and that shows that what the actual effects are to your average investor. Okay, that's not to say that that these aren't really bad activities that are occurring and that we should worry about. It's just there hasn't been any smoking gun studies on those things. Okay, so I don't include them right here, at least for the time being. Okay, so those are some of the things that we know. Yet we still know relatively little. We still don't know HFT's purpose. We don't know if it's needed in markets. Do we really need millisecond speeds? It seems like we'd do fine if we went back to humans, possibly. We don't know where the profits are coming from. Obviously, high-frequency traders are making profits. Where are those profits coming from? We don't know if society benefits from these microsecond and millisecond speeds. And we don't know if we should tax high-frequency trading. Now, these are the important questions, okay? But I challenge you to go find studies that actually deal with these issues. There aren't too many, and the newspaper articles don't really deal with these issues as well. Yet, they're out there, right? And these are the important issues. And this is what I'm hoping to answer with my study, okay? So here's the what I call the great mystery of high-frequency trading. And I think this really gets to the heart of why people consider it mysterious. Apparently, high-frequency trading, HFT, leads to market efficiency and better price determination. But if people are making profits out of it, where are the profits coming? It seems to me ultimately that they are coming from my members, and I do worry about that. Okay, so this is somebody who's in charge of the pensions for the railways in the UK. Okay, so all the studies say high-frequency trading is good for the markets, yet they're making money. Where's this money coming from? Again, I will have something to say about this. So here's my proposal. My proposal is that high-frequency trading to first order and are synchronizers in the market. They synchronize security prices. To the extent that two securities are related to one another, HFT activity ensures that a price change in the first security coincides nearly instantaneously with a similar price change in the second security. Okay? Synchronization increases the efficiency of markets, can be profitable for the firms that do it, and it's impossible to do without high-speed computerized trade. This is really the value add of automating liquidity provision, okay? When you automate liquidity provision, that means that when I'm in New York, I can pay attention to what happens across the globe when I'm pricing my specific security that I'm interested in New York. And because we live in a global economy that's so interconnected, what happens in other parts of the world and price discovery that happens in other securities in other parts of the world are relevant to how I price my security right now. And if I consider that I need to pay attention to these thousands and thousands and thousands of other securities that are traded thousands and thousands of times per second, then now you understand why you might need to update your price on the millisecond level. So what seems it can't be possible at first. It seems, why does it matter if you update on the second level versus millisecond level? If you consider, if you blur your eyes as a physicist, and this is really takes a little bit of thought to begin with, but if you blur your eyes enough, then all securities that are traded to a large extent are a bet on the future state of the global economy. So if you consider all securities to be the same, then when I price any security in the market, I need to pay attention to what happens in all of the other securities across the globe, okay? So that is my argument, and I'll get into it possibly a little bit later, but that's the argument for why synchronization is so important and why it needs to be done at the millisecond level, if you want it to be done most efficiently. So here's the evidence, and again, this goes back to the data that I have from NASDAQ. This is for 120 stocks, and I'll mainly focus on 40 of the stocks, which are the large cap stocks, that are traded on NASDAQ from February, this week in February 22nd to 26th, 2010. All market activity from 26 high-frequency trading firms is flagged. I know all of their trades and all of their quotes, all of their activity. I supplement the data with Thomson Reuters tick data, and you've already seen some of the A plot from this Thomson Reuters data from 2000, 2005, and 2010. So here I'm showing that prices are more synchronized. So what I do is I take, this is the normalized price response on this axis, normalized price response, and this is time, seconds. So the normalized price response is of stock I to a price movement in stock J not equal to I. So I go across this, in this case this is with 35 large cap stocks, and the reason why I'm doing only 35 is because 5 of the securities in the original NASDAQ data set aren't in existence in 2000 and 2005. So I just focus on the 35 that are in existence through all 3 time periods. And I condition on a price movement in all of the, I focus on one security, okay? And then I condition on a price movement that occurs in any other security, any other of these 34 other securities in the market. And then I observe what happens to the price in this security, okay? And it responds to what's happening to all of those other securities. And you can see the timing of this response. In 2000, it took, this took up to several minutes for the full price response to develop. In 2005, it's quicker, but it still took longer than a minute. And then here you can see in 2010, it takes around less than 10 seconds for the full price profile to occur. Okay? So prices have become more synchronized over the last 10 years. So is it high-frequency trading that's doing that? So here's where I use the data set. What I do is I take that original curve from 2010, right here, and then I'm separating out the price response that's due to high-frequency trading, that's the green curve, the price response that's due to non-high-frequency trading, and then another small amount that I can't categorize either way because during the exact same millisecond, a price movement was initiated by both high-frequency trading and non-high-frequency trading. Okay? And you can see that this overwhelming majority of the synchronized price response is due to high-frequency trading. So here's another plot showing that synchronization and high-frequency trading go hand in hand. So I've shown that it does appear that high-frequency trading does synchronize prices. You may ask, well, how much of high-frequency trading is devoted to synchronization? Okay? Maybe it's only a small amount. Maybe this is only telling a very small part of the story. I think that it's telling much more of the story. And in fact, the first order effect of high-frequency trading, because if you plot the correlation of prices, these are high-frequency correlations on 30-second intervals, if you plot the correlation of a security with the index versus the high-frequency trading fraction of volume, you'll see this very nice relationship, which shows that stocks that are traded a lot by high-frequency traders are very correlated with the index, and vice versa. Stocks that have high correlations with the index have high volumes of high frequency volume. Okay? And you use the R squared from this is 0.64. So a majority of the variance in high frequency trading volume across securities is explained through synchronization or by synchronization. So what are the effects of synchronization? So hopefully I convinced you that synchronization is something that high frequency traders do. And possibly, I've convinced you that it's a major activity that they perform, probably the first order activity that they perform. So what are the effects? What should you expect to see when things become synchronized? So we can look to nature, and we can look at animal movements. And there's been very nice studies that have been done that have shown that animals that move synchronously propagate information very quickly, even when only a small number of individuals are informed. So when animals synchronize their movements, information very quickly gets into the group. And so here I'm going to show you a video right here, and you can see very quickly fish that have no idea that there's a predator coming will respond to the predator. Why? Because they've synchronized their motion with their nearest neighbors, and because they've synchronized very quickly, that information propagates across the group very quickly. So go ahead and... Yeah, so again, this is what happens in nature, and there have been these fairly recent papers, and there's new ones coming out, that discuss this in animals. So, in fact, I want to do this plot, but I want to show this really quick, because this is now, for the 40 large cap U.S. stocks, in 1 minute intervals, I'm showing how these prices respond. Through time. So this is 1 day of trading on the NASDAQ stock exchange for these 40 large cap securities. So I've color-coded them according to their sector, but each one of those individual squares is a different security. Movements in this direction are increases in prices. Movements in this direction are decreases in prices, decreases in prices. So go ahead and play. And so I argue that this is very much like animal movement. And you can see that the behavior, the synchronized motion, the way that they move looks very similar to the way that animals move. Okay? And I have a faster plot. I should have put the faster one with this. Because you can really see it in the morning and in the evening when markets are a little bit more accelerated. Can you just do it one more time? So here you can really see the movement together. So here I do now a plot. Over here I've looked at February 25th from 1 p.m. to 4 p.m. And this is the 40 large cap securities, and I'm looking at their price trajectories. Okay? And this is how the price trajectories look through time. This over here, and then I load up a certain portion right here and look at several different securities. I forget exactly which securities those were at this moment, but and now I'm comparing it to this. This is actually a plot of schooling mosquito fish in one of the research papers that I alluded to earlier. Okay, so I argue that stocks do really move together much like animals move. Okay, and therefore we can go to these papers and we can understand what happens when securities are synchronized by looking at the literature in ecology. So here are some of the results put in more explicit terms for synchronization. Synchronization increases efficiency. So this is a simple argument to show how it can increase efficiency. So imagine that country X is likely to default, okay, on their debt. Firm A buys securities that track the probability of default. Okay, so firm A, this is a quintessential informed firm. They buy securities that track the probability of default. Those security prices increase because this firm is buying, and the market tends to increase the prices. If markets are synchronized, the prices of all other securities adjust. So, information that comes in through one security to the rest of the market from this firm very quickly propagates. Okay? When things are synchronized, information very quickly will propagate. Prices are more accurate. An investor who purchases or sells any security in the market receives a more accurate price. If information does come to your security from all other securities in the market. Transaction costs are reduced. Why are they reduced? Well, because liquidity providers are more confident in market prices and will require less of a price concession to transact with an order. Okay? So I've done all of this in a model, which I'll show in a minute, but this is just showing you conceptually what's going on. So who loses in this scenario, right? Somebody should be losing if high-frequency traders are making profits. Let's see who loses in this kind of a scenario. So imagine you have country X and country Y, and that they're related to one another, so that when X is likely to default, so is Y. But imagine firm A mainly pays attention to Greece, or pays attention to country X, and firm B mainly pays attention to country Y. Okay? So, firm A is influencing the price of this security, firm B is influencing the price of this security, and high-frequency trading allows information transfer between the different securities. So firms A and B make less money when prices are tightly synchronized because they now must compete with each other when processing information. Previously, if you didn't have a strong connection between the securities prices due to high-frequency trading, then these firms had monopolies to some extent of information on the individual securities. So high-frequency trading forces informed investors to compete with one another across securities, okay? And it will actually reduce their profits. So here now, hopefully to convince you even more of this story, this is a high-frequency trader. This is the CEO of one of the major high-frequency trading firms, and testimony to the United States Congress describing what he does and what happens in the market. So go ahead and play that.
A tremendous amount, I would say the majority, of the volume that occurs in today's markets is premised upon the fact that securities, both within the same markets and across markets, have semi-stable correlations to each other. So that when price discovery happens in one instrument, it must propagate to other instruments that are correlated to it. And regulators currently have no clue how that works and have no tools to analyze those effects.
Okay, so straight from his mouth, he's saying that a tremendous amount, the majority, he thinks, of high frequency, of volume in the market is premised on the fact that price discovery must transfer from one security to all of the other securities in the market, which is exactly the story that I'm trying to tell, and the evidence seems to back that up. So let's go to a model which supposedly regulators don't understand how this is happening in markets, so let's possibly develop a model to help understand what is occurring, and so we can help regulators understand what happens. So here's the model. I have n different securities. Here I'm showing 3 different securities, but the model is generalized to n different securities. They're traded asynchronously over a single period. One unit-sized order to buy or sell is submitted for each security. So you either have a buy or a sell for each security, only one order, and all of those things come into the market asynchronously. Orders are immediately transacted by liquidity providers at the fair price, in other words, at the expected future price of the security. Okay? So these orders come into the market asynchronously, are priced by liquidity providers at the fair price and transacted. Okay? And I'm going to understand what happens in this model when you allow prices in one security to propagate to the other securities versus siloing everything separate from each other. Okay? And we'll see what happens in the model when you look at those 2 different scenarios. So this is just defining the rest of the model. The final price of a security increases or decreases by delta, so this is just some constant, with equal probability. So it either goes up in price or down in price with 50% probability. Orders are correlated with final price changes. So if you observe a buy order, that's correlated with the future price being higher. If you receive a sell order, that's correlated with the future price being lower. This is just a standard thing that is done in microstructure models, and in fact, it holds in reality. Buy orders do correlate with higher future prices, and sell orders with lower future prices. And then finally, final price changes of securities are correlated with one another. So the 3 different securities that I showed here, the assumption is that they have some kind of correlated structure with one another. Okay? So if you blur your eyes, they're similar. They are the same security. So here's an example for just one security in the market. So the original price is 50. A buy order comes in, and then liquidity providers price that buy order at the fair price. Okay? Well, we know the final price has to be 51 or 49. That's just defined in the model. The original price was 50. We know that if there's a buy order, and this is just defined in the model, it's one of the parameters of the model, buying correlates with future price movements in the positive direction, and the probability of there being a buy, given that the future price is 51, is 0.75. Therefore, you can rearrange this using Bayes' law and determine the probability of a positive movement given a buy order. That's 75%. So therefore, the fair price is 50.5. So you saw a buy order come in, it's transacted at the fair price, which is 50.5. You can calculate the cost and the average error in this scenario. So this is a siloed market. Each individual separately gives you something like this diagram. Now let's see what happens when we add another security to the market, which is related to this original security. So the second security is added, it has the exact same properties as the first, except they're not the exact same security. They just have correlated price movements, okay? And the correlation coefficient is 0.8. So now let's see what happens to the average cost and pricing error for this buy order now when we add the second security. So when you add the second security can either come after or before the original buy order. Let's assume that it happens after the original buy order. Well, then that's not going to change anything at all, right? If the second security comes after the original buy order is already priced, and the price is exactly what it was in the original example, 50.5. But if the second security is bought or sold beforehand, that has information about what the future price is for the original security. And I won't go through the details. I have the equations. I don't have time to go through them. But you can calculate exactly what the fair price is based on these conditions happening before a buy or a sell in the second security. And you'll see the cost, average error, cost, average error, averaging over all of those. When markets are synchronized, in this very simple example, the costs go down for transactions, and the average error also goes down. So markets become more efficient when you synchronize them. And now I've shown them, hopefully I gave you an argument previously for that, and now I'm showing it with a formalized model. So what should worry regulators about high-frequency trading based on the data that I'm showing and on the model that I presented? Well, when prices are very tightly connected to one another, errors can quickly propagate through the financial system, okay? So if you have something that's really erroneous that happens, let's say it happens in the futures market, somebody places an order that's way too large for the futures market and crashes the price there, that very quickly will propagate everywhere else. And in fact, that's exactly what happened during the flash crash. It very quickly propagated from the futures markets into the equities markets, and the equities markets just blew up at that point. And you had these really weird things happening in equities where things were trading at zero and at several $1,000s above fair market price. Okay? Another thing that should worry regulators, HFT firms are largely run by scientists and engineers, so they're not trained in finance and not trained in economics. Okay? Are they enforcing spurious relationships? So they're likely to take the relationships from the data. They say, oh, well, these should be synchronized according to this, because they should be synchronized this amount, because that's historically what it's been. Okay? Are they inducing kind of spurious relationships in markets because they may not fully understand fundamentally why these securities are related? So I've done some preliminary analysis that looks at whether or not the relationships that are at high frequency make sense or not. So here I'm showing a networked picture of the market of these 40 different securities that's derived from the 30-second correlation matrix. So you should think of this as the structure that's being enforced at high frequency on these 40 different securities. And sure enough, it does look like the structure that's being enforced makes some sense, because the industrials are at the center of this structure, and then you have technology stocks and technology companies tend to be clustered together, healthcare, consumer securities, financial, so on and so forth. They tend to cluster together. So there does seem to be some sense to it. So here are the conclusions. There are an average over 1,000 transactions per second in U.S. equities alone during the trading day. Okay, so that's U.S. equities alone, 1,000 per second. Okay, high-speed computerized trade is needed to keep prices connected. If that's how fast markets are operating, because that's how many transactions occur, then you need high-speed computers to keep prices synchronized. Markets will be most efficient if prices are updated at timescales corresponding to the frequency of trade, which is currently milliseconds to microseconds. And then high-frequency trading activity requires careful monitoring to ensure that errors don't propagate and that correct relationships between securities are being enforced. Thank you.
Мы немножко по времени перешли чуть-чуть за лимит, поэтому два вопроса позволю за себе.
Austin, thanks for a wonderful speech. Your comparison with natural world aroused two questions, one coming from another. First is, wouldn't synchronization lead to herd behavior And wouldn't someone like to abuse that herd behavior in the market?
Yes, that's entirely possible, right? I mean, obviously, if the price movement occurs in a certain sector of the market or a certain area of the market, high-frequency traders, if they synchronize things, will very quickly propagate that in other places, okay? Now, if you look at the model, and it's very subtle, but in the model, overall what happens is you have some traders in Security 1 and some traders in Security 2 who are informed, and others who are uninformed and just placing really noisy trades, okay? That you can get a signal out of this much better if you look at both securities rather than just one. So yes, errors are propagated in the same way that information is propagated, but of course it's a signal extraction problem, and the more information you have, if you look at more securities, the better the signal comes out from the noise. Now what happens if that original signal, or what you perceive as the original signal, is just plain erroneous, which can happen, and did happen during the flash crash? I don't know. You need circuit breakers in place, you need other kind of, again, this is the question that regulators should address. To be honest, my research is meant to point out what are the first order, again, I'm a physicist by training, what are the first order effects of high frequency trading, how should we understand it to first order, and how should we then regulate it and deal with it once we know that first order effect. Okay? There are other things involved, and this talk is not meant to say that this is all, the end-all be-all of what high-frequency trading is. It's my argument for the first order effect of high-frequency trading.
Okay, thank you.
Thank you. I think we need to clarify the definition of efficiency. There are two kinds of efficiency: micro, of relative prices, and synchronization is related to that. But there is another question, and even more important, about the overall price level for the market. And I doubt that high-frequency trading is something to do with that. And please excuse me for what I'm going to say. That's probably my ignorance. I think that your analogy to fish is a kind of bit offensive to mankind, because fish do not think.
Yeah, sure. No problem. So for the first one, yes, you're entirely correct. This is dealing, high-frequency traders entirely deal with statistical arbitrage. They're arbitraging things that are related to one another, okay? So if the original signal that's coming in from the supposedly informed people in the market, the informed firms in the market that are getting these overall prices correct, high-frequency traders depend on those people, okay? And whether or not they're getting things correct, I don't know. But you're right, high-frequency traders are not in the market. And you can see that. Look at the people who work in high-frequency trading firms. They're not economists. They're not people from financial economics. They're people from science and engineering backgrounds who understand very easily that, if two things are related to one another, I can make the prices jiggle in the right way. Okay? So that I agree with. Now, with the analogy to well, so I wouldn't say that. I mean, because animals can think, okay? And they think in very simple heuristic ways. So if I see food, I go to it. And if I see a predator, I move away from it, okay? And if I synchronize things across a group, then all of a sudden the collective motion that results, this is one of the beauties of nature. It looks like this organism somehow has a collective brain over and above all the individuals that tells the entire group what to do. But one of the great things about those papers in ecology is showing, look, these simple heuristic rules are actually what's allowing information to propagate across the entire group and make it look like somebody is paying attention from above and coordinating everything. But the same thing can happen in markets. You can have individual securities and individual informed firms for different securities that follow heuristic rules. Oh, I think this. I have a good feeling about this firm. I have some kind of information about this firm having a pretty good quarter. I'm going to trade on that in the market. But on an aggregate level, if you have high-frequency trading, if you synchronize all of these signals that are coming in, and I agree they're noisy signals, but if you synchronize all of them, then what comes out can be, to some extent, informed. And it can look like there's some kind of higher intelligence which is getting the rest of the market correct. Now, I'm not willing to say that that's actually what's happening. This is meant to be a little bit controversial and to get people to think, but that is a possibility. Thanks.
Thank you very much.